All right, hi everyone. This is the hedge fund portfolio project for the group Retained Learnings for Group 7, prepared by Michael, Alexis, myself, and Katie.
Hi there. My name is Michael Calvelli. I hail from Virginia, where I got a BS in Information Systems back in 2019. I work as a clinical systems analyst in sunny Hawaii, and I am going for my dual MBA and MSIS.
I'm Alexis Ewald. I got my Bachelor's of Science in Healthcare Administration from Florida Southern College. I did move back to Maine after college, and I'm now an administrative coordinator for a primary healthcare organization here.
Hi, I'm Lexington Peterson. I'm from Kansas. I went to school at Pittsburgh State University, where I earned a Bachelor of Science and a Bachelor of Science in Engineering Technology. Today, I live in Cincinnati, Ohio, and I work for a plastics machinery manufacturing company as a project manager.
Hi, I'm Katie Ramsdell. I'm from Maine. I got my Bachelor's of Science in Business Administration from St. Joe's in Standish, Maine, and I'm currently a payroll and budget specialist for a public school department in Southern Maine. And I'm getting my master's in with a concentration in public administration.
So for this project, we were tasked with creating a market neutral, beta neutral, long, short hedged portfolio. This is a technique that aims to generate positive returns by pairing long and short positions in the same or adjacent sectors using beta neutrality as a form of risk management. Throughout this project, we were able to gain a better understanding of the inner workings of the portfolio and the management of one from the very beginning. We created this online hedge portfolio with the sector quality asset types: the US sector equity, real estate, bonds, commodities, and currency. The initial goal of this portfolio's development was to have a net beta exposure as close to zero as possible. And by achieving beta neutrality, we were able to reduce risk, making the portfolio independent of the gains or losses of the overall market. These must be highly correlated, as they should be in the same industry or subsector, and the hedge fund portfolio must consist of multiple asset types as listed above. The multi-asset portfolio we constructed for this project contained one long-term stock, four long-term exchange-traded funds, or ETFs, and five short-term ETFs. The portfolio value began with an initial $100,000 capital investment, and the investment was divided where $50,000 was invested in long-term assets and $50,000 was invested in short-term assets. And in the following slides, you can see the 5 long and 5 short positions that were selected for this initial portfolio.
So as Alexis mentioned, when selecting each of these stocks and ETFs for the long and short positions, ideally we wanted those to be within the same industry or subsector. And a good indication of that is a correlation value as close to 1 as possible. So using the portfolio visualizer in this course, we had all of our ETFs in the one stock, NVIDIA, as well as SHY as a reference to the market. So the values for the correlation values were pulled from this table, and that's where we see our long-term positions and our short-term positions and their relation to one another. We'd also like to talk about the types of plays that we had. So NVIDIA was the only stock. So the pure stock play here is what that play was, where the long position is a stock and the short is a sector ETF. The risk here is moderate. And then the rest of our pairs was considered a double alpha sector play. So this is a sector ETF has a long position as well as a short position, and this is a little bit more risky with a moderate plus ranking. So to elaborate on our long positions and why we selected them, NVIDIA for the US equity sector, we chose it because it's a tech leader. It's been in the media a lot recently because of their innovations with graphic processing units and artificial intelligence, machine learning, and looking at its performance since 1999, they've had 174,000% return, which is just unheard of. Another point that stood out was that their revenue this past year was 61 billion, and the year before that it was only 27 billion. So within a matter of a year, it doubled. So we anticipated that the price would go up, and we would see profits from that. Ultimately, when selecting long positions, we chose stocks and ETFs that we perceived as undervalued and were hedged against the short positions with the anticipation that that stock would rise and we would gain our profits there. The multiple asset types was to reduce risk, and the small expense ratio was something that stood out for the BND of 0.03. The others were 0.4. You'll notice for NVIDIA, it doesn't have an expense ratio, and that's because it's a stock. But ultimately, the weighted beta is the value that we used for beta neutrality. So for the short positions, when selecting these, we considered the ETFs to be overvalued, and we anticipated that the stock price would decline, and that's where we would find our profits. All of these were ETFs. They also, in the pairs, were in the same industry. Again, just want to emphasize that. These had relatively small expense ratios for the first three. The last two had relatively high expense ratios at 0.93 and 0.78. But we were really trying to match our aggregate weighted beta of our short positions to the long, and that's where we would achieve potentially a zero value. That was our goal, to be independent of the market.
And as Lexington said, which I'm going to elaborate on a little bit, as we know, asset correlation is how different investments move in relation to one another. So those movements, when they move in the same direction, are positively correlated, which and when they move in the opposite direction, they're negatively correlated. So for instance, a correlation of a 1.0 is considered a perfect correlation or a perfect match. And as Lexington said, a lot of ours are in the 0.9 range and close to 1. And so the long and short-term pairs, the long and short position pairs described were purposefully selected within the same industry. The real estate, bonds, commodities, and currency pairs have historically shown similar trends. And as you can see, this is how closely our assets perform in relation to one another. So when selecting our pairs, we were very careful to evaluate how closely each pair corresponded to ensure that our long position investments increased while our short position investments decreased in value. In order for our neutrality to work, all the pairs needed to correspond to one another, which would still encourage the other to succeed. And kind of going hand in hand with that, the security market line, which was another factor for us in reviewing our investments that we made, the security market line, based on the expense returns before taxes for our portfolio, shows that our long position investments produced less than expected for a given level of risk in most cases. We strategically selected long position stocks that were a mixture of high risk, moderate risk, and low risk to ensure that we had a diverse opportunity for growth. Meanwhile, for our short-term position stocks, while we took the same approach for risk, our efforts paid off and our stock prices dropped as we had hoped and anticipated. While we knew NVIDIA was certainly a riskier investment, we took a chance on the tech leader and hoped our efforts would pay off. Unfortunately, this wasn't the case, but we were fortunate to see a decline in NVIDIA's stock pair. And as we continued to look through our investments, it appeared that most performed similarly in their pairings. The only one that didn't was our long position, the GLD ticker, and its pair, the DBA ticker, which both had an increase in their stock price. Overall, we feel that we did well with selecting our overvalued and undervalued short and long-term investments. And we stand behind the investments we made. And we feel that the outcome was all based on timing, which we'll get into more in a minute.
By the time we liquidated our portfolio on 4/19, our longs ended up with a loss of minus 19.41% compared to our initial investment, but our shorts ended up with a gain of 7.44% in comparison with our initial investment. While this short position strategy paid off, this significant loss from our long position ultimately pushed our portfolio into the red. Playing a big part in this is the NVIDIA stock of almost 20% of our initial investment, which had to do a lot with circumstance. On 4/19, there was an announcement of significant tech sell-offs in the industry. News actually quoted it as saying it is NVIDIA's worst day in 4 years for share price. This resulted in a batting average of 50% wins. This comes from our longs having 1 win and 4 losses, and our shorts having 4 wins and 1 losses. So they offset each other in the end. While our portfolio ultimately did end up with a slight net loss, this was largely minimized by our pair setup. Since we picked pairs with high correlation rates, this reduced the risk, and it mostly paid off. Each pair ended up balancing an asset with a gain and an asset with a loss, and this helped minimize the losses incurred mostly by our long positions. Adding up the ETF expenses, the trading fees, and the taxes on our gains onto our subtotals did bring our loss to negative $2,426.36, ending up with a total loss of minus 2.43% from our initial investment. Over the past few years, our portfolio had varying degrees of success. 2021, it had a small gain. 2022, it had a large loss. 2023, it had a very large gain, over 40%. And starting out in 2024, it did have a significant gain. However, over the short term, in the 4 weeks that we did have our portfolio, this did result in a loss, which ultimately did result in a loss in our portfolio overall.
So ultimately, the lessons learned as a group, we all got good practice in for the development and management of a market neutral, long short hedge portfolio, and understanding beta neutrality to mitigate risk, and also just the importance of the different asset classes in that. The pairs selected had to be within the same industry. They needed to highly correlate, and that's where we had the values that were ideally close to 1 to ensure that our portfolio moved independent of the market. Again, this was a balance of risk and reward. NVIDIA was a pretty aggressive stock to choose for a long position, and in hindsight, we would have set it as a short position because it appeared it was peaking. Ultimately, it didn't appear that we were independent of the market, considering 9 of our 10 positions saw a decline. But when referencing SPY's performance from March 22nd to April 19th, it had a loss of 5%, while our portfolio only had a loss of 2.3%. So ultimately, the market did decline, but our portfolio did a little bit better. So for our conclusion, while the portfolio resulted in a loss, We feel that our logic was sound at the time that we made it, which was 2 weeks into this course. And we learned along the way many mistakes that or changes that we would have made to mitigate risk and minimize our losses. Ultimately, we feel like we've improved our financial literacy and had good experience developing a portfolio and managing it. We feel more empowered to make informed investment decisions in our personal lives, and also in our roles as professionals. And these are our references. Thank you.